All right. Hey, everyone. Welcome back. You know how much we love to geek out about all things finance. And today we're diving into a topic that a bunch of you have been asking about trading.
It's one of those things that can seem kind of mysterious and maybe even intimidating if you're not familiar with it.
Yeah, for sure. I mean, we've all heard the stories about people making or losing a ton of money in the markets, but what does it actually mean to trade? And more importantly, how do you do it successfully?
Well, that's what we're here to break down today. We're going to go deep into the different types of trading, explore some common strategies, and try to demystify the whole process.
Exactly. We've pulled together a bunch of research from different sources to give you a well-rounded view. So let's start with the basics. What exactly is trading?
At its core, trading is simply buying and selling financial instruments with the goal of making a profit from the changes in their prices.
So like stocks, bonds, currencies, that kind of
Sure.
thing.
Exactly. Those are all types of financial instruments that are traded on different markets around the world. And the thing is, their prices are constantly fluctuating, going up and down based on all sorts of factors like supply and demand, economic news, company performance, global events, you name it.
Okay, so the key is to buy low and sell high, right? Buy when the price is low, hoping it will go up, and then sell it when the price is high, pocketing the difference.
Yeah, in theory, that's the basic idea. But of course, it's not always that easy. If it were, everyone would be a millionaire trader.
Right. So what makes it so tricky?
Well, for one thing, predicting those price movements is no walk in the park. There are so many variables at play, and the markets can be incredibly unpredictable.
Makes sense. So what's the secret sauce? How do successful traders figure out when to buy and sell?
That's where trading strategies come in. There are tons of different approaches, but before we get into specific strategies, it's important to understand the different types of trading.
Okay, so before we try to ride the waves, we got to figure out what kind of surfboard we need.
Pretty much.
Okay, I like that analogy. So what are the main types of trading out there?
Well, you think of it as a spectrum. On one end, you have day trading, which is like the super fast, high energy version.
Day trading, that sounds intense.
It is. It's all about buying and selling within the same trading day, trying to capitalize on those short-term price movements. Like imagine a stock, let's say company ABC, that has a history of jumping up in price right after the market opens. Maybe they're always in the news for something positive. A day trader might buy shares as soon as the market opens and then sell them an hour later, hoping to make a quick profit off that little jump.
So it's like sprinting in the trading world.
Well,
Quick bursts of intense activity.
exactly. But it requires a lot of focus and discipline. You got to be glued to your screen, constantly analyzing charts and making split-second decisions.
Yeah, it doesn't sound like my style. I'm more of a set it and forget it kind of investor. What about something a little less heart pumping?
Well, then you might be more interested in swing trading.
Swing trading. What's that all about?
It's a bit more relaxed.
Yeah.
Instead of holding trades for minutes or hours, swing traders hold them for a few days or even weeks. They're looking to ride those bigger price swings, those ups and downs that happen over a slightly longer period.
Okay, so it's more like catching a wave and riding it for a while instead of just skimming the surface.
Exactly. A good example might be a stock like, say, XYZ Corporation. Let's say their stock price tends to bounce back and forth between $50 and $60 pretty consistently. A swing trader would aim to buy it when it's closer to $50 and then sell it when it gets closer to $60, trying to capture that $10 difference.
So it's still about timing the market, but you have a little bit more breathing room than a day trader.
Right. You don't need to be making those split-second decisions.
All right, got it. So we've got day trading, the sprinter, swing trading, more of a middle distance runner. What about those of us who are in it for the long haul? Where do we fit into this picture?
Ah, you're talking about position trading.
Position trading.
Yeah, this is the marathon of trading. Position traders hold their investments for months, years, sometimes even decades. They're not concerned with those short-term fluctuations. They're looking for long-term growth potential.
So it's more like, I don't know, investing in a company that you believe in and just letting it ride?
Exactly. Think about those early investors in companies like Amazon or Apple. They held on to those stocks for years and years, even through ups and downs, and ultimately came out way ahead.
Okay, that makes sense. So we've got our sprinter, our middle distance runner, and our marathon runner. Is that everyone? Are those all the trading types?
Well, there's actually one more that's even faster paced than day trading, believe it or not. It's called scalping.
Scalping. Like, what are they taking tiny little pieces off the top?
You could say that. They're trying to make tiny profits on very small price changes, often holding trades for just seconds or minutes.
Wait, seconds. Seriously, how is that even possible?
It's all about volume. Let's say a stock like Teco has what's called a bid-ask spread of, say, 5 cents. That means there's a 5-cent difference between the price someone's willing to buy it for, the bid, and the price someone's willing to sell it for, the ask. A scalper might buy a massive volume of shares at the bid price and then immediately sell them at the ask price, making a tiny profit on each share. But if they do this hundreds or even thousands of times a day, those tiny profits can really add up.
Wow. That sounds incredibly intense, like you'd need lightning reflexes and nerves of steel.
It definitely takes a certain type of personality and a deep understanding of how the markets work. It's not something I'd recommend for beginners.
Yeah, I could see that. So we've got our four main types: day trading, swing trading, position trading, and scalping. And it sounds like each one requires a different mindset, different skills, and a different level of risk tolerance.
Absolutely. It's all about finding the approach that best aligns with your personality, your goals, and the amount of time and energy you're willing to commit.
So, knowing when to buy or sell is important, but it's only part of the equation, right? There are also different strategies for deciding what to trade in the first place.
Right. Picking the right assets to trade is crucial, and that's where all those different trading strategies come into play. And that's what we're going to dig into next.
Okay, so buckle up, everyone. We're about to explore the fascinating world of trading strategies. Stay tuned. Okay, so we've covered the different trading styles, but now let's dive into the strategies. Where do we even start? There are so many ways to approach the market.
It can definitely feel overwhelming. There are a ton of different approaches out there, each with its own set of rules and indicators.
So how do we make sense of it all?
Well, let's break it down into some of the most popular strategies. One that's often talked about is trend following.
Trend following. So basically just hopping on the bandwagon.
Kind of. It's about identifying an established trend in the market, either up or down, and riding that trend for as long as it lasts.
Okay, so if a stock is going up, 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 you buy in and hope it keeps going up.
Exactly. But the key is being able to identify a real sustainable trend, not just a random blip. Experienced trend followers use all sorts of tools and indicators to analyze charts and figure out the strength and direction of a trend.
So you're not just blindly following the crowd, you're using data and analysis to make informed decisions.
Right. And just as important as knowing when to buy is knowing when to sell. A common mistake is holding on for too long, hoping the trend will continue forever, but all trends eventually reverse.
Got it. So you need to know when to get off the train before it reaches the end of the line. What about momentum trading? Is that similar to trend following?
They have some things in common, but momentum trading focuses more on assets that are experiencing a surge in price movement, often due to news events or maybe a surprise earnings report. Think of it like catching a wave that's already cresting. You're trying to ride that wave for a short but potentially very profitable time.
So it's about identifying those stocks or other assets that are really taking off and jumping on board for the ride.
Yeah. Momentum traders often use technical indicators to try to spot stocks with high trading volume and price volatility, things that suggest there's a lot of excitement and movement around a particular asset.
So it's even more fast-paced and potentially more risky than trend following.
It can be. The rewards can be big, but you need to be quick and decisive, and you got to be prepared for the possibility that the momentum could shift quickly.
Okay, so you need to have nerves of steel and be ready to react fast. Definitely not for the faint of heart. Let's shift gears a bit and talk about a strategy that sounds a little less adrenaline-fueled. What about mean reversion? Can you explain how that works?
Sure. Mean reversion is based on the idea that prices tend to revert back to their historical average over time. So let's say a stock normally trades around $50 a share. But suddenly, some bad news comes out, maybe an earnings miss, and the price drops to $40. A mean reversion trader might see that as a buying opportunity, believing that the market overreacted and the price will eventually climb back up to that $50 average.
So it's almost like betting on a rubber band snapping back to its original shape after being stretched.
Yeah, that's a good way to put it. It's about identifying those times when the market has maybe gone a little too far in one direction or the other.
But isn't that kind of risky? I mean, what if those seemingly temporary deviations actually turn into long-term trends?
That's always a possibility. And that's why it's important to do your research, understand the underlying factors driving those price movements.
Okay, so it's not just blindly assuming everything will always go back to normal. You need to have a reason to believe that the price is out of whack. What's the last strategy on our list?
Breakout trading. This one's all about identifying those moments when an asset's price breaks out of a defined range, either above or below certain levels that traders watch closely. So let's say a stock has been bouncing around between $20 and $25 a share for several weeks. And then suddenly it surges above $25 on high volume.
So it's like the stock is finally breaking free from its cage.
Exactly. And breakout traders believe that this kind of move could signal a shift in momentum and a potential for further gains. They might jump in right at that breakout point, hoping to ride the wave.
Sounds exciting. But I imagine there are risks involved here, too.
Definitely. Not all breakouts are real. Sometimes it's a false breakout, and the price quickly reverses. Experienced breakout traders use all sorts of tools and techniques to try to confirm that a breakout is legitimate before they jump in.
Okay, so we've got trend following, momentum trading, mean reversion, and breakout trading. And seems like each one requires a pretty deep understanding of the markets and a willingness to take on a certain level of risk. What are some of the key things people should consider when choosing a trading strategy?
Well, first and foremost, you need to think about your own personal risk tolerance. How much are you comfortable losing? Because let's be real, losing money is part of the game. You need to be okay with that.
Yeah, no one likes to lose money, but it's true that it's part of the game. So if you're someone who freaks out at the slightest sign of red on your portfolio, maybe day trading or momentum trading isn't the best fit.
Probably not. Those are pretty high-risk, high-reward strategies. If you're more risk-averse, swing trading or position trading might be more up your alley.
Right, risk tolerance is huge. You got to know yourself and what you can handle. What about time commitment? Some of these strategies seem like they require you to be glued to your screen all day.
Yeah, for sure. Some strategies are definitely more demanding than others. Day trading and scalping, for example, require a lot of time and focus. You got to be constantly monitoring the markets and making quick decisions.
So not ideal if you have a full-time job or, a life outside of trading.
Right. If you're not able to dedicate a significant chunk of time to trading, you're probably better off with something like swing trading or position trading. Those strategies allow you to take a more hands-off approach.
Makes sense. So let's say I'm ready to dip my toes into the trading waters. What's the best way to get started? Should I just, open an account and start throwing money at stocks?
Whoa there, slow down. It's like anything else. You wouldn't jump out of a plane without a parachute, right?
Well, it depends on the plane. Just kidding. But yeah, point taken. Don't jump into trading without a plan.
Exactly. Start by educating yourself. There are tons of resources out there, online courses, books, even mentors who can teach you the ropes. You could also practice with a simulator or a demo account before risking any real money.
Oh, so you can kind of test the waters without actually getting wet? That's a good idea.
Definitely. It's a great way to get a feel for the markets, try out different strategies, and see how you react under pressure without putting your hard-earned cash at risk.
Okay, so education and practice are key. But how do you actually choose a strategy? How do you know which one is right for you?
It really depends on a few things: your personality, your risk tolerance, your financial goals. And honestly, it might take some trial and error to find what works best for you.
So it's not like a one-size-fits-all kind of thing.
Nope. Everyone's different. Some people thrive in fast-paced, high-pressure environments. Others prefer to take a more methodical, long-term approach. It's about finding your own style, what feels comfortable and fits your lifestyle.
Okay, so we've covered a lot of ground today. We've talked about the different types of trading, explored some popular strategies, and emphasized the importance of education, risk management, and finding the right approach for you. Any final words of wisdom before we wrap things up?
Yeah, just remember that trading is a journey, not a destination. It's a constant process of learning, adapting, and evolving. And the most important thing is to approach it with a curious mind and a willingness to learn from your mistakes. Because trust me, you will make mistakes. We all do.
That's good advice. So as we wrap up this deep dive into the world of trading, we want to leave you with a question to ponder. Now that you've heard about these different strategies, what resonates with you? Do you see yourself as a quick-thinking day trader, a patient swing trader, a long-term investor, or maybe something else entirely? This is just the beginning of your exploration, and we encourage you to keep learning, keep researching, and keep discovering what works best for you. Because ultimately, the best trading strategy is the one that aligns with your individual goals, risk tolerance, and lifestyle.
And hey, if you want us to go deeper into any of these strategies or explore other aspects of trading, just let us know. We're always up for another deep dive.
Until next time, happy